Today we'll be talking about IFRS 10, which is the International Financial Reporting Standard for consolidated financial statements, which we've been learning so much about lately. With that, we'll be covering what this standard is, how it applies to us, how it's being used in the world around us, and we'll even look at a sample case study of how this actually works. So it's important to know what this standard is, and so some things to know are that it was published on May 12th, 2011, and according to the International Accounting Standards Plus, IFRS 10 outlines the requirements for the preparation and presentation of consolidated financial statements, requiring entities to consolidate entities that it controls. Control requires exposure or rights to variable returns and the ability to affect those returns through power over an investee. Now this sounds like a very similar reasoning to what we learn in US standards, and they are quite similar. Next, you're probably wondering, how does this apply to us? We are under US standards, not IFRS standards. Well, the key word here is international business. Now, it's not uncommon that a U.S. firm will go out and purchase an international company, and you very well could be dealing with this in your job in the future. The second reason is that the U.S. could potentially be adopting or merging with international reporting standards. The point of this would be to eliminate some of the complexities in international acquisitions that we face today, like revenue recognition. With that, we'll look at how this standard is being used in the world today. Something that quite recently happened in March 13th, 2017, Intel, an American company, purchased an Israeli company called Mobileye for $15 billion. Some background for this: Intel is a computer chip making company that purchased an automobile tech company. For the reason to compete with companies like NVIDIA to build systems for driverless cars. This is a very big and key event in tech and automobile company industries, as projections show that this acquisition will most likely drive up the innovation and production of driving assists in new vehicles. Things like backup cameras and self-driving vehicles. These are likely to increase in the years to come from this acquisition. And in this acquisition, because it is an international acquisition between US and Israel, IFRS 10 would be used in preparing the consolidated financial statements of the new parent company that Intel has become. Here we are actually looking at the IFRS 10 procedures for consolidating two companies, and we'll actually be using all three of these steps in this case study that we're about to look at. And just below you'll see the directions for this case study, where parent company has owned 80% of the shares of subsidiary Ltd. Since subsidiary's incorporation. Prepare consolidated statement of financial position of parent group. Now, a statement of financial position is quite like our balance sheet that we have. Because this is such a simple example, we will only be looking at the statement of financial position and not the income statement. And one note to look at is that the measure of non-controlling interest is at its proportionate share of subsidiaries' net assets. Now, this proportionate share idea, this is actually a different method of accounting for non-controlling interest in the International Financial Reporting Standards. So here we have our statement of financial position, and as you can tell, it actually looks quite like our consolidated statements work paper. And as you could see before, our first step is to make an initial combination of all the accounts between of the two companies, which is shown right here. And this is done simply by taking the parent corporation's account, adding it to the number in the subsidiary's account, and to get the combined all the way until the end. So one thing that stays the same in IFRS standards is eliminations. Those things that we all know and have come to love over the past few chapters. So the first thing that we'll do is we're going to eliminate the investment in the subsidiary company's accounts. As you can see, we're currently on step 2, where we'll be using both of these sections here. We'll be eliminating the carrying amount of the parent's investment in the subsidiary and the parent's portion of equity in the subsidiary as well as doing step 3, which is eliminating items related to intergroup transactions, which as we know them as intercompany transactions. So like I said, we'll be crediting the $70,000 off of the investment in the subsidiary, and then we'll also be debiting the $80,000 in equity that we've now purchased, and as well as debiting the retained earnings of $9,000, debiting goodwill for $6,000, non-controlling interest for $25,000. And we'll see how we calculated this $25,000, $9,000, and $6,000 here in just a moment. So starting with non-controlling interest, we start with our net assets of the subsidiary, which was $125,000 shown above, and then we take the non-controlling interest share in the subsidiary, which is 20%, as we own 80%. And if we multiply those two numbers together, we get our $25,000 in non-controlling interest. Secondly, we'll do goodwill, which is the fair value of the consideration paid, which is in other terms our purchase price, which was that $70,000 investment in the subsidiary. Then the non-controlling interest at acquisition, which is the non-controlling interest percentage shown up here, multiplied by the 80,000 shares that were initially there in our acquisition. And so we'll subtract that in order to get our goodwill of $6,000. And lastly, we'll do the consolidated retained earnings calculation, which is the retained earnings of the parent company, which is $62,000. We'll use 100% of that, but we'll only use 80% of the subsidiary's retained earnings, which was $45,000, and 80% of that is this $36,000 here. Add those two together, and we get our combined consolidated retained earnings of $98,000. Again, here are those numbers that we calculated: the $6,000 of goodwill, the $9,000 in retained earnings, and the $98,000, or my apologies, the $25,000 in retained earnings, or non-controlling interest, and $98,000 in retained earnings. Now, how we got this $98,000 here instead of in the eliminations column is our initial combination got us to 107, but our actual retained earnings should be 98,000 with our 20% that we don't own. So we needed to debit it 9,000 here. And if we check at the bottom, our eliminations equal, meaning that we are finished with this consolidated work paper. And our debits equal, and our assets equal our equity and and liabilities, so we're all happy. If you'd like to take any additional looks into what I was researching, here is my work cited. From this, I hope you were able to learn about the differences between our standards here in the US and international standards. I hope you enjoyed learning about IFRS 10 as much as I did, and I hope you enjoyed it. Thanks.